So we have seen these banks rise in the session today on expectations of this bumper stimulus package proposal from the President-elect Biden. To what extent do they benefit under some of these components that we now have details of?
Well, I'd say that U.S. banks benefit from lucky number 3. First, you had Pfizer Monday, November 9th, and that was when the first U.S. vaccine was announced, and that should mean less credit losses for U.S. banks. Second was Fed Friday. That was December 18th, and that's when the U.S. Federal Reserve had their mid-cycle stress test, and it showed that banks were not only strong enough to avoid issuing new equity, but are strong enough to actually buy back their shares. And then the third part of the lucky number 3 is Georgia Tuesday, or last week, when the elections resulted in a Democratic-controlled U.S. government. And what that means is the reflation trade is back on, more spending, higher interest rates, and you certainly see that with President-elect Biden's plans that have come out. So any one of these would be a game changer, but to have all 3 in a period of 3 months is, I'd say the odds of something like that happening are like 1 out of 500. So this is certainly better news for U.S. banks and their ability to support the U.S. economy.
Well, and certainly the more the yield curve steepens, the more people are going to say, hey, it's finally hooray for banks. I mean, the banks have actually, though, done pretty well in this last year of, stock market sell-off and comeback. So how big a part of your bullishness on banks, particularly Citi, JP Morgan, and Bank of America, is about that economic recovery? How much is it the specific of these institutions?
Well, I would say we have Act 1 and Act 2. Act 1 is that once the war on COVID is won, banks should benefit from a peace dividend. And that peace dividend includes lower credit costs, lower expenses that have been put in place for COVID, and less waivers of fees. 5% of Bank of America's employees were reallocated simply to deal with the pandemic. So that peace dividend comes back to the banks as part of what you really could term a typical recovery out of a recession. So that's Act 1. But Act 2 is also very exciting. Before the pandemic, the largest banks, especially Bank of America and JP Morgan, were helping to lead the way in digital banking. And that should lead to the best efficiency U.S. banks have ever seen several years out.
Mike, this is a chart that I was trying to show our viewers earlier, taking a look at the leadership of banking stocks in terms of this value rotation trade that has finally started to take hold. I am wondering, though, if you take a look at that, the group's GTI Global Strength Indicator is now in severely overbought territory. So, if you're still looking at technicals, this is a pretty cautionary sign. How much more runway is there for this rally?
Well, I'm a fundamental analyst. I look at profits and expected profits, and that's ultimately what drives bank stock. So that's why we publish 3-year price targets, that if we have a very low rate environment, we still see 50% upside over 3 years. But if we get to a more normal rate environment, then we could see these 3 stocks, Citi, Bank of America, and JP Morgan, doubling over 3 years. But I would like to point out, as well as the banks have done since Pfizer Monday, November 9th, they have still underperformed the broader U.S. stock market by 19 percentage points year over year. So they've only recouped half of the underperformance from the past year.
Mike, first of all, I want to also mention that you own all these stocks, family-wise, firm-wise, et cetera. Obviously, you're putting your money where your mouth is. One really quick question, if you could answer quickly, on Citi, because they got hit so hard last October. Was it a huge fine because their risk management controls weren't there? Are you that confident now that they've got all their ducks in a row?
Well, I only own a couple shares of stocks, and the reason is so I can go to annual meetings and stand up and speak up, and I do that at Citigroup every year and say, why don't you restructure? Why don't you sell parts of your operations in Asia or Mexico or elsewhere? So I will say this new regulatory order from the Fed reduces the degree of our enthusiasm, but Act 1, benefiting from the recovery from this recession, should help Citigroup in a big way. Act 2, we should hear for the first time from the incoming CEO of Citigroup, Jane Fraser, about what her plans are going to be. So the next year, we're fine. For the next 3 years, we want to see what the new CEO's plans will be.